Hey, welcome to Macro Atlas. Today we're going to be discussing the macro forces that are aligning against Bitcoin and why is it not the most optimal time to be accumulating Bitcoin. So this video is going to be full of data and content. We're going to first discuss the macro point of view, and then we're going to look at the price structure of Bitcoin and how it compares to previous cycles and what that says, right? So of course, nothing said in this video is financial advice. It is only for educational purposes only, but I hope you find inspiration and you learn something from this video. If you do, don't forget to leave a like as it helps this channel tremendously. Before we start, my name is Mo. I'm a crypto and macro market speculator. I've been a speculator with real capital for the past 5 years, but I've been studying the industry for over 7 years now. So I've always been interested in markets, money, and everything in between. So consider subscribing to this channel if you actually want to see market views that do play out often, right? So if you go check some of the videos that we put out recently, you'll see I've talked about the whole move from here to there to the breakout here to the resistance we might get here, and as well this one we got it on point as well, right? Even the bottom we were able to predict it with arrows and stuff. A little bit about my experience. I did long Bitcoin way in the previous bear market cycle around here. I've exited right there my whole position and I've started shorting right there, right? And again, I've shorted the market here. So I hope you can find some of this information valuable, but remember to act only upon ideas that you have to research yourself, as tips is the most dangerous things for any market speculator. First thing first, what's the most important thing of why Bitcoin cannot really be finding its low right now is simply because the interest rates are expected to be rising right in September. And if you looked at it a day or two ago, it would have been one rise in 2026, on September 2026, and then I think a second rise in September 2027. But that today had changed, right? I do believe we're gonna be getting more than one raise hike, especially with the ongoing geopolitics that is happening right now that would push oil prices higher, and that would push inflation higher. And I know the Fed is having problems that the economy might be slowing, and borrowing costs is already tightening, and there was some cracks showing, right? The private credit problem that happened, which they had to inject some liquidity into the market. We can even see it on the chart today, how they injected the liquidity and they stopped injecting. So the problem is starting to go away. But I think the inflation problem is going to be very sticky, and we're going to see something similar to the 1970s and 80s when we actually get 2 rate hikes, which wasn't a good time for the market, right? Yeah, so I don't believe we're going to only get 1 rate hike. I think the September 2027 at least is going to go up again. You can see even the percentages for 3 rate hikes are increasing, and just a rate drop absolutely tumbling down, right? So rate hikes are coming, and it's not going to be one. That's what I think. If we go to the liquidity, right, and see that the problems that happen with the private credit, you can see that during that phase, they were printing around 7.5 million a day. They were basically just expanding their balance sheet by 7.5 million a day, so they're pressuring treasuries. We could see that right here. So if we go here, they started to actually purchase some of the treasuries right here, and that was the kind of liquidity to save the markets, the private credit banking industry, right? And you can see that at the same time they were increasing their balance sheet, they were also increasing their liabilities. So the total liquidity, the net liquidity hadn't risen by much, okay? So they were giving it somewhere and they were taking it from somewhere. So the net liquidity didn't really go up. You might see that the M2 supply going up or something like that, but the net liquidity hasn't really changed by much. If anything, it had gone more negative, right? So liquidity is being sucked out of the market. They had this boost in liquidity for a while, where they were buying around 2.7 billion a day to save the private credit, as they said, and as actually was evident. But then this has changed around April, mid-April, where they started to purchase 2 billion a day, and then it stopped right there around that time, and then they had a new schedule every like few month period they do release a new schedule, sometimes every month period. That new schedule will actually reduce from 2 billion a day to 1.3 billion a day. So they're reducing the gas. We have seen something very similar to that in the previous market cycle, where actually Bitcoin found the top. So you can see how much they're purchasing on their treasuries is very important. Here they were buying 4 billion a day, and then they stopped right at the peak. And then they reduced from 3.5 billion a day, and their schedule just slowly went towards 1 billion a day until it completely stopped. And then the crash happened, right? And we are in this zone, as a lot of people agree, finally, right? But on this channel, I did speak a lot from the start that we are in this zone. And you can see some of the videos we posted even 3 months ago, right? So on the channel, you do get kind of the more speculative, because it is less sure, but I'm willing to take the risk and say, yeah, I think we are here much earlier than all people, so we can actually plan, right? This is what you get on this channel. We do give a lot of insight that it will be repeated on other channels, like the Jesse Livermore, right? I think of, yeah, the Jesse Livermore, right? We've talked about this a lot of times, and now people are catching up to this and actually using it for the stock market. But Jesse Livermore has been one of my favorite market speculators of all time. I use his volume analysis, I use his charts, and I use his strategies. I read his book 6 times. So amazing guy. Reminiscence of Stock Operator, that's his book if you're looking to actually read it. And that's the point, when I read it, is the point where I actually turned to a profitable investor. I hope you can maybe even give it a chance. So yeah, liquidity is tightening, interest rates seem to be rising, and of course, the stock market, based on the snippet that it has been following, which I've been shared a long time ago too. Now, a month ago, maybe people start to look into it, is actually getting to its highs, and we could see a nice pullback here that can push Bitcoin price down. And that's why it's pretty risky right now to accumulate Bitcoin, in my opinion. Maybe you should wait a little bit till things maybe look more favorable in terms of the macro, and then the price structure needs to show that. That's how I trade, right? Even though conditions are looking bearish, I wouldn't take a short until the price structure confirms that. Another thing that is worrying, I hope you know that if the US dollar goes up, then it is bad for risk assets such as Bitcoin and even the stock market. Well, it is the season for, on the chart, it is the season for a stronger dollar. And just a few days ago, I read that a lot of Asian countries are having problems with their currencies. So if you see the chart tells you something is about to happen, right? Or this is going to happen. The ticker really speaks the story. But then later you would read news that, that's why. And one of the things that actually could push the US dollar higher is not only through geopolitical uncertainty, but rather than weakening Asian currencies. So a lot of people, like for example Turkey, and I've heard the Philippines or something, are experiencing some major currency debasement happening to weakening to their currencies, and therefore they are printing and they are trying to support their currencies. Another way they could support their currencies is buying stronger currencies such as the US dollar, which would push the price of US dollar higher, right? The chart says it, and hopefully some of the macro things are going to start to come up and validate that idea. But I would definitely recommend tracking the DXY, because if that breaks out of the right range, as you can see, it happened multiple times in history, you do get a period where the US dollar just breaks out. So I'm not going to talk a lot about it, but you can pause the video and see the pattern that is happening, the parallel, the breakdown, the consolidation, and the breakout, right? The oil is going lower, but if you have seen during that war, oil just plays within those ranges, and I've been trading that so far. So if oil goes down to the entry zone, I do believe we're gonna get maybe some more geopolitical tension that would actually push oil price up. So both parties do not want oil to go up, as it would hurt both their economies and the world economy in general. So they need to make sure that they, having conflict within meaningful ways, not to hurt the world economy by too much, right? Because they do get a lot of pressure from the international community. And therefore, I believe that once we hit the entry zone level, or if we look at it more, in a macro point of view, let's take out the price of Bitcoin. Then if we get more into the neutral absorbed level, which is below $85 per barrel, that's where we're actually seeing the most renowned escalation. And if you hit the peaks, that's when you are getting the most renowned de-escalation. And you can even just track the news and see some of the news, and you can see it on the chart how the game is being played out. And most importantly, of course, 30-year government bond yield, the Treasury yield, is going higher. The trend does not seem to be fading, and that is very dangerous for risk assets such as Bitcoin. Right. So if, of course, just to explain it in one way how it could be bad for Bitcoin is because why would you hold money in risk assets such as Bitcoin or the stock market if you can get a safer return relatively? If you hold Treasury yields that pay you 5 to 6% a year, right? I mean, the market averages 7 to 10%, and you don't know what's going to happen. But Treasury bond yields, 6-7%, not bad, right? So you can see how some investors would think. And we are getting to 2008 levels, and if you exceed beyond that, I think that's pretty symbolic, and the symbolism alone would drive markets towards the acceleration phase of where the macro conditions point to, right? I think the symbolism works a lot in markets as well. So those are some of the macro stuff, all right? So let's see some of the market structure stuff that, well, what can we say about Bitcoin in terms of market structure? First thing is if you just pause this and maybe align the boxes that have been happening. So I've been building this kind of for myself. That's why it doesn't really look YouTube heavy. But if you pause and you track some of the things that are happening there, you would understand that we're actually just past that phase, and we are maybe in that phase. It could be here, it could be lower, not sure. We need to see how that pulls out. But the bottom is definitely not looking like the market structure it should be, especially comparing the similarities between this market cycle and the previous market cycle, right? Secondly, if we determine that we are here, which a lot of people finally agree on, right, that we are in that zone. Even Ben got it wrong. Crypto Rover at some point got it wrong, and they really had me doubt my analysis, and that's not good. You know, like you should stick to your analysis most of the time, if not all. And yeah, everybody agrees we are here. So in terms of market structure, if you take, let's just move that a little bit away. If you first take the data, right? Take the data and analyze the whole drawdowns of all bear market cycles of that leg down. Right here, you see it right there as well, and you see it right there as well, right? If you take all that data and you understand the breakout point usually happens around there, that data right there, and then you measure from here, I would like to even be more safe, and I would measure it from there. Okay, in case that phase right here is that there, as we had seen there. You know, if that phase is right here, then we should really measure the breakout point from that level. So if you measure that and we go like that, you would see that the first point is 45%, and that was the previous market cycle and the less severe one. So that leg right there from the breakdown. Okay, so that's the range, and the maximum is 61. That's where that box comes from, where price should go on the second leg down move. Now, I do not believe we're going that low. As you can see, we're going in a descending order, 61, 47, 45 on that breakout from that second consolidation phase. Sorry, for the first consolidation phase. Then it should go there. But I do not believe it might be the severe. It could be, and that's one data point that suggests that, but I do not want to believe so. But that's one data point that says that. If you also take, where is it called? The bearish pattern of the previous market cycle, since it has been very similar, so why not use it as an inspirational way to understand how this bear market cycle would work and how specifically this leg down will work out. Then if you take it, and you would notice that this structure really aligns with that structure. And remember that it happened on a higher, you know, the highest point of that peak and the highest point of that peak. And why those two look very similar is, well, You can see right there, right? The rising channel, the bull market support, man, we went above it, 200-day moving average rejection, and then actually breaking down from the rising bull flag and getting into an important moving average. This one was the 100-week SMA, but this one is the 200-week SMA. Here we have been kind of consolidating in a similar range to that, but here we're seeing more resistance, right? So you can see the similarities. So if there are massive similarities, then why do we not compare them? Now, if you leave it like that, then you can see where it hits, right? It just fits perfectly. But if we can adjust it a little bit to see to the market structure that is playing out this time, which is less severe, is you might see something like that, right? That phase right here can be attributed to that, and then we get some kind of consolidation phase. Here it retested that support line, right? Which we had flipped to resistance, and similar to here, that would happen if we measure that support line that we flipped to resistance right there. So you'd get something like that, and you would see that the bottom would happen around 47, and then we would actually consolidate a little bit between 50 and 52, which aligns with other theories. Okay, that's one way it could happen, severity, but another severity point toward that direction. Maybe that would be, for example, the bear market bottom. And maybe this is just half the move. And maybe there should be another move that comes right there. I have no idea. But this is one data point that we can actually study and analyze and track and see where it goes. That's what I'm saying. The range of the low, for me, would happen between 48 to 35,000 of this leg down. This would need a major catalyst to go down there. Here, we would need just some form of catalyst to bring us down there. That's my opinion, and we will see how it goes with time, of course. The more data points we get on price, the more we can definitely be more confident in our conviction of where we could reach, right? A little bit more about price structure. Let's move to moving averages, right? So I do not believe we're going to find a low at the 200 week SMA, right? Previously, we had broken down from it, and we even had retested the 300 week SMA, right? So we had even below it. So that would put us to the first range that we worked on, which is around 48,000. Okay, that would work out perfectly to that theory. So if we get down there, can we go lower, for example, to the 400 week? Or I would even argue to 350, at least. So 350 or the 400, because here we found support at the 350, but here we had found support at the 200, 300. Previously, at the bear market bottom, it had been 200, but we had retested during COVID. So you can see, if we just analyze the bear market cycles, we're going yellow, then red, but red and a half. And here, maximum, we should get to the red and a half for the bear market cycle. We should maybe even reach the 400, the purple line. It would make sense as we are going in a descending order. Not always. For example, that bear market cycle went too low, but you need to also understand that bear market cycle was kind of extended because the bull market cycle was extended, and therefore this bear market cycle didn't get 364 days to find the bottom, but it was 420 or 411, something like that, right? So yeah, that bear market cycle was one, longer, two, more severe, and I believe that can be attributed to the euphoria that happened during that period, right? So that was pretty big move, right? You had a mini bear market cycle, I believe, in that period. I would attribute it to that. And usually bear market cycle get like 2 legs down. Here we saw one, and then a second one, and then a third one. So we did get an extra leg that is less severe. Therefore, I do believe that trend is rather reliable, right? This is one leg, and if you say that's a support, that's a second leg. That's what we have in here. And here you had also seen something very similar. That's one leg, that's 2 legs, and you got also a very small leg right here that was induced by a catalyst, which was the FTX collapse. I believe if the FTX collapse hadn't happened, you would have maybe went up from there. It could be argued that way, right? So, of course, the minimum we should go based on this moving average analysis is, I would say, realistically around 47, 48,000 for the bear market low, but we could also reach 42 and lower if there is a catalyst, which again, in line with this analysis, right? Another thing we could look at, we had done that one, good. Let's see if we, yeah, the last one would be here. So if you go and analyze all the bear market cycles from top to bottom, you would get such data, right? And with this data, what you can do is actually form a range again. And that range would be for the least drawdown from the previous bear market cycle, 77%, and the maximum drawdown, which is around 87%. That happened in the first bear market cycle, yeah, around 77%. So if you see the descending order and you do some math, you know how much we are subtracting each cycle, then realistically, based on just statistics, we should go minus 69%, which put us around that range, around 38,000. 38,000, again, fits nicely with around here, right? That 38,000 thingy. I don't believe we're gonna really hit this range, because if you see, there's also a descending order, 61, 47, minus 45%. So by minimum, we should go between 47 to 45 was minus 2%, between 45 and 43 is minus 2%. So minus 43% would put you around that 38,000. So that's why I believe the lowest we can go is actually 38,000 for this leg or the bear market as a total, because sometimes the second leg down move does form the bottom of the bear market, such as that one, but sometimes it does not when we have another induced drawdown, right? So yeah, I do believe we might be going to around 38,000, and probably also that's basically my target bear market range, okay? Between 38 to 50,000 Bitcoin. That could be induced through one leg down, just one move of the last bear market leg down, which I do not believe is going to be the case. I believe that we're going to maybe hit like around here and then get another just leg down to the low sometime later during September, October timeframe, when the first rate hike will happen. I think that will be a nice point where we can actually find the bear market bottom for at least some renowned strength. Like, oh, is the bull market gonna happen again? I have no idea. I mean, macro conditions are not looking good. That needs to be seen when the bear market bottom has to happen, and how's the sentiment and how's the macro outlook looking. It is, but we're definitely gonna see some strength during October and a little bit after. But yeah, this is my point of view on the market. I hope it had inspired you in one way or another. But if you do like it, do please leave a like for this video. It does help the channel tremendously, especially for a new channel like that. And if you do want to watch more content like this, so you get actually up-to-date analysis with back to data, macro, and market structure, then consider subscribing, because I would like to see you again. I'll see you in the next time.